Hello everyone, welcome to the 115th episode of me learning how to trade in Forex. So in the last episode we finished off doing drawdowns and maximum drawdown explained. Basically, drawdown is the percentage of one's capital after a series of losses, after a series of losing trades. Well, it's a reduction of one's capital after a series of losing trades, but it's expressed as a percentage basically. So normally calculated by getting the difference between the relative peak in capital minus the relative strength. Traders normally note this down as percentage of their trading account. Yep. Losing streak. So although a 70% trading system seems very good, but out of 100 trades you don't really know when the other 30 losses is going to happen. So it could happen in the first 30 trades you do. By then, the 70 wins that you got remaining wouldn't even matter because you already lost all your capital in the first 30 trades. So, yeah, so that means traders then only risk a small percentage of their total bankroll so that they can survive their losing streaks. This is what you must do as a trader. Drawdowns are part of trading. So key being a successful Forex trader is coming up with a trading plan that enables you to withstand these periods of large losses, so the losing streaks, which are bound to happen eventually. And part of your trading plan is having risk management rules in place to, I guess, cope with that. Only risk a small percentage of your trade bankroll so that you can survive your losing streaks. Remember that if you practice strict money management rules, you'll become casino in the long run, so you always win. And yeah, and now we're on to never risk more than 2% per trade. So oh no, that's the wrong one. What am I doing? So never risk more than 2% per trade. Date is the 24th. How much should you risk per trade? Great question. Try to limit your risks or real risk to 2% per trade. Try to limit your risk to 2% per trade. But that might even be a little high, especially if you're a newbie Forex trader. Here's an important illustration that will show you the difference between risking a small percentage of your capital per trade compared to risking a higher percentage. So risking 2% versus 10% per trade. Trade number 1. So let's say you start off 20,000 as your total count, which is a lot actually. Very lot. 2% risk on each trade, you risk $400 each trade. Your trade number 1. Oh no, this is, you look at it this way, right? Okay, so trade number 1, you risk 400. Okay, you lost that one. So now you got 19,600. Risk 2%. Okay, you lost that one as well. So take away 392, you got 19,208. Okay, you lost another 2%, 384. So on, so on, so on. So keep losing, keep losing. You can do up to 19 trades. You've done 19 trades, you're on a 19 basically losing streak, and you still got around 13,903. Well, that minus 278 actually. So about 13,000, what was it, 625? I think. So 12,000, oh no, 13,625. So you got that. Dollars left on your 20th trade, or to use on your 20th trade. Whereas if you risk 10%, so you start off with 20,000 as usual. 10% of 20,000 is 2,000, which is a lot already. So you're down by 2,000, so you got 18,000. Keep going, keep going, keep going. and by the time you reach the 19th trade, you only got $3,002 left. And if you lose that trade as well, then you basically got 2,000 and what is that? $2,702 to use for your 20th trade. So yeah, not a lot. So not a lot compared to, well, not a lot, definitely not, missing out on a whole bunch actually, compared to when you're risking 2% on each trade rather than 10% on each trade. So yeah, you can see that there is a big difference between risking 2% of your account compared to risking 10% of your account on a single trade. If you have to go through a losing streak and lost only 19 trades in a row, you would have gone from starting with 20,000 to only have $3,002 left if you risked 10% on each trade. You would have lost over 85% of your account. If you risked only 2%, you would have still had 13,903, which is only a 30% loss of your total account. Of course, the last thing we want to do is to lose 19 trades in a row, but even if you only lose 5 trades in a row, look at the difference between risking 2% and 10%. So only losing 5 trades, so here, yeah, you're down by 5,000 basically already if you're using 10% on each trade, so very, very loads. If you risked 2%, you would still have 18,447. If you risk 10%, you would only have 13,122. That's less than what you would have had even if you lost all 19 trades and risked only 2% of your account. The point of this illustration is that you want to set up your risk management rules so that when you do have a drawdown period, you will still have enough capital to stay in the game. So set up your risk management rules so that when you do have a drawdown period, you will still have enough capital to stay in the game. Can you imagine if you lost 85% of your account, you would have to make 566% of what you are left with in order to get back to break even. Trust us, you do not want to be in that position. What do I have to do to get back to break even? Here is a table that will illustrate what percentage you would have to make to break even if you were to lose a certain percentage of your account. So if you lost 10% of your total account, percentage required to get back to break even, you have to make 11%. 20%, 25%, 30, 43, 40, 47, 67. So already you can see like the percentage required to get back to break even is increasing really, really fast compared to, so that's only 1% in the beginning, 5%, 13%. That's like more than double already. This is what, 27%, so double of that. 50%, that's double, literally double. 60, 150, more than double. 70 to 33, that's like more than triple basically. 80 to 400, that's 5 times. 90 to 900, that's 10 times. So yeah, if you lost 90% of your account, GG's mate. You can see that the more you lose, the harder it is to make it back to your original account size. This is all the more reason you should do everything you can to protect your account. So don't do this basically, don't do 10%. Not sure how well or poorly your trade went? Use our gain and loss percentage calculator to help you know what percentage of the account balance you have won or lost. It also estimates the percentage of current account balance required to get to the break-even point again. So that's the calculator there. By now we hope you have gotten it drilled in your head that you should only risk a small percentage of your account per trade so that you can survive your losing streaks and also avoid a large drawdown in your accounts. Remember, you want to be the casino, not the gambler. Gambler house you. So you want to play for the long run, not for the short wins. reward to risk ratio. So, to increase your chances of profitability, you want to trade when you have the potential to make 3 times more than are risking. So, to increase your chances of profitability, you want to trade when you have the potential to make 3 times more than you are risking. So if you're risking £1, then you want to make £3, ideally. If you give yourself a 3 to 1 reward to risk ratio, you have a significantly greater chance of ending up profitable in the long run. So a 3 to 1 reward to risk ratio is the target. For profitability in the long run. Take a look at the chart below as an example. So 10 trades, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Loss, 1,000, but using a 3 to 1 reward to risk ratio. So you're risking 1,000 each time. So you lose the first trade, but then the second trade you win, so you win 3,000 because 3 times 1,000, which is the reward to risk ratio. You lose 1,000, you win 3,000, you lose 1,000, win 3,000. So you lose, win, lose, win, lose, win, lose, win, alternatively, and in total you lost 5,000. But overall, you won 15,000, so you still come up with a $10,000 profit basically in 10 trades. In this example, you can see that even if you only won 50% of your trades, you would still make a profit of 10,000. Just remember that whenever you trade with a good risk to reward ratio, your chances of being profitable are much greater even if you have a lower win percentage. But, and this is a big one, setting a large risk to reward ratio comes at a price. On the very surface, the concept of putting a high reward to risk ratio sounds good, but think about how it applies to your actual trade scenarios. Let's say you're a scalper and you only wish to risk 3 pips. Using a 3 to 1 reward to risk ratio, that means you need to get 9 pips. Right off the bat, the odds are against you because you have to pay the spread. If your broker offered a 2 pip spread on EURUSD, you have to gain 11 pips instead, forcing you to take a difficult 4 to 1 reward to risk ratio. Considering the exchange rate of EURUSD could move 3 pips up and down within a few seconds, you would be stopped out faster than you can say uncle. If you were to reduce your position size, then you could widen your stop to maintain your desired risk to reward ratio. Now if you increase the pips you wanted to risk to 50, you will need to gain 153 pips. By doing this, you are able to bring your reward to risk ratio somewhere nearer your desired 3 to 1. Not so bad anymore, right? In the real world, reward to risk ratios aren't set in stone. They must be adjusted depending on the time frame, trading environment, and your entry exit points. A position trade could have a reward to risk ratio as high as 10 to 1, while a scalper could go for as little as 0.7 to 1. However, this isn't always the case in real life. In the real world, reward to risk ratio aren't set in stone. They must be adjusted depending on the time frame, trading environment, and your entry slash exit points. There's another point which they made is interesting. Whenever you trade with a good risk to reward ratio, your chances are being wait, isn't it reward to risk ratio, not risk to reward ratio? Okay. Even if you have a low win percentage. Right. Okay. So when using a high reward to risk ratio, the chances of being profitable are higher, even if you have a lower win percentage. Right. Study your losses to realize gains. So, traders are often so fixated on their winning trades that they totally ignore their losing trades. But it's from your losing trades from which you stand to learn the most. Here are 3 ways to learn from the trades that didn't work out. 3 ways to learn from trades which didn't work out. Number 1, calculate your performance. Calculate Look up your past trade transactions. If you can't find them, ask your broker for help. Look up your past trade transactions. Look up your past trade transactions. If you can't find them, ask your broker for help. Gather your profit and loss data so that you can begin to analyze the factors affecting your overall performance. And gather your profit and loss data to analyze factors affecting your overall performance. Now, find your average gain. Average gain equals total gain divided by number of profitable trades. Next, find your average loss, which is average loss equals total loss divided by number of unprofitable trades. Once you have both numbers, let's display it as a ratio so you can dig deeper in where your profits and losses are coming from. So the profit-loss ratio is average gain divided by the average loss. For example, let's say you had 10 profitable trades with an average $200 gain per trade, and 5 unprofitable trades with an average of $300 loss per trade. So your profit-loss ratio would then be 0.67. A profit-loss ratio refers to the size of the average profit compared to the size of the average loss per trade. In the example above, since your average gain is $200 and your average loss is $300, your profit-loss ratio is 0.67. So I think we want the profit-loss ratio to ideally be above 1 basically, because if it's less than 0, then you're pretty much losing them more than what you're making. This means your average profit is only 67% of your average loss. Said differently, you lost 1.5 times more money than you gained. $300 average loss versus $200 average gain. Fortunately, you won 10 trades out of 15. Your win percentage was 67%. Your win percentage is calculated by using number of profitable trades divided by total trades. So 10 divided by 15, which is 67%. The average gain versus the average loss per trade also tells you how well you're managing and closing out your positions. If your average loss is more than your average gain, ask yourself, do I generally stick to my original trade plans or diverge from them? When my trades are profitable, what influences my decision to exit? When my trades are unprofitable, do I exit according to my pre-planned risk management rules or hold on to losing trades too long? By answering these questions, you can identify weaknesses and build better trading habits over time. Right, okay, so find average gain. So average gain equals total gain divided by number of profitable trades. Find average loss, because average loss equals total loss divided by number of unprofitable trades. Find profit loss ratio, which is profit loss ratio equals average gain over average loss. The profit loss ratio refers to the size of the average profit compared to the size of the average loss per trade. Win percentage. Find win percentage. So win percentage is equal to number of profitable trades divided by total trades. That's a number of total trades, isn't it? Number of total trades divided by number of total trade, the average gain versus the average loss per trade. So the average gain versus the average loss per trade, that's your profit loss ratio. Wait, your profit loss and the win percentage is the same. Is that just a coincidence, or? The average gain total versus the average loss ratio. Yeah, that's the profit loss ratio. The profit loss ratio also tells you how well you're managing and closing out your positions. If your average loss is higher than your average gain, ask yourself, do I generally stick to my original trading plans or diverge from them? Generally stick to my original trading plans or diverge from them. When my trades are profitable, what influences my decisions to exit? What influences my decisions to exit? When my trades are unprofitable, do I exit according to my pre-planned risk management rules, or hold on to losing trades too long? By answering these questions, you can identify weaknesses and build better trading habits over time. Number 2, drill down on your orders. If you want to learn from your past mistakes, you need to pay extra close attention to your average losses, because you will have the most control over them. Pay extra attention to your average losses, because you have the most control over them. Even when you do your homework, a position can move against you in the blink of an eye, turning a profitable trade into a loser. It's how you manage and control these situations that can make or break your success as a trader. If you found yourself in these situations in the past, sit back and reflect on how long and why you allowed the position to fall before you acted. Why you allowed your position to fall before you acted. How you manage and control situations. How you manage to control situations. How you manage and control situations where a profitable trade turns into an unprofitable trade. Can make or break your success as a trader. If you found yourself in those situations in the past, sit back and reflect on how long and why you allowed this position to fall before you acted. So if you found yourself in these situations in the past, sit back and reflect on how long and why you allowed the position to fall before you acted. Focusing on your average losses will help you identify a bad habit in your trading approach that is probably contributing to mediocre results. Most likely you're letting your losing trades run for too long. You probably need to cut them sooner. Try exiting a losing trade before it reaches your average loss. You may experience an immediate improvement in your performance. Exiting your losing trade before it reaches your average loss. It's possible to be wrong more than you're right and still come out ahead. It's possible to be wrong more than you're right and still come out ahead. So it's possible to lose more trades than you win and still come out ahead. But your average gains need to be way bigger than your average losses. Basically, you may not be right often, but when you are really right. The easiest way to track this by figuring your trade expectancy. The easiest way to track this is by figuring your trade expectancy. There we go. Focusing on your average losses will help you identify a bad habit in your trading approach. Try exiting a trade. Try getting a losing trade before it reaches your average loss. You may experience an immediate improvement in your performance. It's possible to be wrong more than you're right and still come out ahead, but your average gains need to be way bigger than your average loss. Basically, you may not be right often, but when you are, you really are right. You are really right. The easiest way to track this is by figuring out your trade expectancy. Okay, calculate your trade expectancy. So how much profit you're making per trade, right? Expectancy is the average dollar amount you expect to gain or lose per trade based on previous performance. Is the average dollar amount you expect to gain or lose per trade based on previous performance. It combines your your percentage of profitable trades and average gains per trade with your percentage of losing trades and average loss per trade. For example, let's say 30% of your trades in the past 3 months were profitable and your average gain was $300 per trade, while 70% of your trades were unprofitable and you had an average loss of $100 per trade. Based on the calculation above, you would expect an average gain of $20 per trade. So that's 30%, which is your wins, times by your profits, your average gains, and your percentage of loss times by average loss per trade. So 90 minus 70 is $20 per trade, a gain of $20 per trade. As you can see, expectancy basically refers to the average amount you can expect to win or lose per trade. So expectancy is calculated by expectancy is equal to percentage winning trades of winning trades times by average gain minus percentage of losing trades times by average loss. As you can see, expectancy basically refers to the average amount you can expect to win or lose per trade. You should aim for an increasingly positive expectancy with each trade. You should aim for an positive expectancy with each trade. You should aim for an increasingly positive expectancy with each trade. If the opposite is happening, revisit your losers to see where the breakdowns might be occurring. A lot of new traders are so obsessed with their profit-loss ratios that they are unaware that a bigger picture exists. Your trading performance depends largely on your expectancy. Your trading performance depends largely on your expectancy. Summary. Examining your performance on a regular basis can help you better understand the behaviors and other factors that may be influencing your trading outcomes. Paying close attention to losses is a great way to identify any shortcomings. Pay attention to your losses to improve your trading outcomes. Right. Summary, risk management. '24. Be the casino, not the gambler. Remember, casinos are just very rich statisticians. It takes money to make money, everyone knows that, but how much does one need to get started in trading? The answer largely depends on how you are going to approach your new trading business. It varies from person to person. Drawdowns are a reality and will happen to you at some point. Drawdowns will happen to you at some point. The more you lose, the harder it is to make it back to your original account size. This is all the more reason that you should do everything you can to protect your accounts. The more you lose, the harder it is to make it back to your original account size. This is all the more reason that you should do everything you can to protect your accounts. We hope that it's been drilled into your head that you should only risk a small percentage of your account on each trade so it can survive your losing streaks and also avoid a large drawdown in your account. Only risk a small percentage of your account in each trade. Big drawdowns usually mean a quick death for your trading account. The less you risk on each trade, the less your maximum drawdown will be. The less you risk on each trade, the less your maximum drawdown will be. The more you lose in your accounts, the harder it is to make it back to break even. This means you should only trade only a small percentage of your account. The smaller the better. Less is more. 2% or less is recommended. 2% or less is recommended. Or less per trade is recommended. Yep. 2% or less per trade is a highly recommended guideline for everyone to follow. We stress guideline because it depends on other factors besides your experience like a trading system, mainly how often it takes a trade. The more currency trades you take per time frame that you focus on, the less you want to risk per trade. The more currency trades you take per time frame that you focus on, the less you want to risk per trade. Lastly, don't forget to factor in changing market volatility. Volatility may require you to make adjustments to your entries and exits. Ignoring leverage. Why most new Forex traders fail. So, most professional Forex traders and money managers trade one standard lot for every 50,000 in their account. Most professional Forex traders trade one standard lot for every 50,000 in their accounts. They trade a mini account. This means they trade one mini lot for every 5,000 in their account. Let that sink in to your head for a couple of seconds. If pros trade like this, why do less experienced Forex traders think they can succeed by trading 100k standard accounts with a 2000 account or 10k mini lots with $250? No matter what the Forex brokers tell you, don't ever open a standard account with just a 2000 or a mini account with 250. Heck, some even allow you to open accounts with just $25. The number one reason new traders fail is not that they suck, but because they are undercapitalized from the start and don't understand how leverage really works. New traders fail due to undercapitalization from the start and not understanding how leverage works. Hello, my name is Leverage. Now die. Don't set yourself up to fail. We recommend that you have at least $100,000 of trading capital before opening a standard account, $10,000 for a mini account, and $1,000 for a micro account. Of course, open an account only when you are consistently good. So if you only have 60,000, open a mini account. If you only have 8,000, open a micro account. If you only have 250, open a demo account and stick with it until you come up with additional 750. Then open a micro account. If you have $1, find a job. Okay. If you don't remember anything else in the lesson, at least remember what you just read above. Okay, please reread the previous paragraph and ingrain it into your memory. Just because brokers allow you to open an account for only $25 does not mean you should. Here's why. We believe most new traders who open a Forex trading account with the bare minimum deposit do so because they don't completely understand what the terms leverage and margin really are and how it affects their trading. It's crucial that you're fully aware and free of ignorance of the significance of trading with leverage. If you don't have rock solid understanding of leverage and margin, we guarantee that you will blow your trading account. Oh my G, I should have opened a demo account. Recommend to have at least 100,000 of trading capital for a standard account, 10,000 for mini account, and 1,000 for a micro account. Okay, I'm going to leave this episode here. In the next video, we're going to carry on with the number one cause of death of Forex traders with leverage and margin explained. So, thank you all for watching. Peace.